Can someone give me a sign?
Yes, the chairman of the former chairman of FIRS, Alhaji Nami, is already with us, and Professor Waleke is also with us. And Ladi, please, I want to continue to retain my job. Oh. The group chairman of NGX is also here with us. So
group
please.
Chairman of the NGX. Yes, is right here.
Thank you very much, Ladi. Thank you, Tunde. Yes, thank you, Ladi. Nice to hear that summary you have done for the opening. We are all ears waiting and to contribute to. Thank you.
Thank you so much. Thank you so much. Thank you. All right. So without further ado, we're not going to waste time. We're going to have Professor Uche Waleke address us very soon. But before I welcome him, I'd like to reel out his profile. Professor Uche Waleke is a distinguished financial economist and professor of capital markets. He's the pioneer director of the Institute of Capital Market Studies and the pioneer head of the Department of Securities and Investment Management at Nasarawa State University, KEFI. He's the pioneer president of the Capital Markets Academics of Nigeria and was a former honorable commissioner for finance in Imo State. He also held the position of chief economist and director of research at the Securities and Exchange Commission, Nigeria. Professor Uche Waleke has contributed significantly to policy and regulatory development, having served as a member of the Nigerian Stock Exchange Advisory Committee and the Governing Council of the Chartered Institute of Bankers of Nigeria. He currently chairs the NCC Committee of Experts on Capital Market Studies in Nigerian universities and is a member of the Daily Trust Board of Economists. He's a chairman, board of directors, Nasarawa State University Microfinance Bank, and Nasarawa State University Consult Limited. He also serves as an independent director non-executive director at Cowrie Treasurers Limited. At the national level, he is a member of the Presidential Committee on Fiscal Policy and Tax Reforms and a member of the Governing Council of the Nigerian Economic Society. Professor Waleke is a fellow of several prestigious professional bodies, including Capital Market Academics of Nigeria, Chartered Institute of Stockbrokers, Institute of Capital Market Registrars, Institute of Chartered Accountants of Nigeria, and the Chartered Institute of Bankers of Nigeria, Chartered Institute of Taxation of Nigeria. He wears many hats. He's also the author of 10 Ps of the Nigerian capital markets and essentials of non-interest capital markets. Professor Uche Waleke, it's a great pleasure to welcome you for your presentation.
Yeah. Thank you so much, Ladi. Good evening, everyone. Just for clarity, am I supposed to be speaking before the chairman's opening remarks? Should I go ahead?
Yes, sir. That's the flow today, sir.
Okay, thank you very much. Let me quickly start by recognizing the chairman of this roundtable, former executive chair of the Federal Inland Revenue Service, my good friend, Dr. Nami. I also have the pleasure to recognize the group chair of the Nigerian Exchange Group, my life brother.
Thank you very much, Professor.
Thank you, sir. I'm indeed delighted to see you and to know that you're here.
Thank you, Prof. Appreciate it.
And of course, the MD CEO of ASAM Limited, the convener, Dr. Tunde Amolebe. I want to thank you especially for giving me this opportunity, Dr. Tunde. This is my second time. I also had this privilege last year to speak at the ASAM's webinar series. I also want to quickly acknowledge my friend Ladi. I've been on his program a couple of times on Channels TV, and it's also an opportunity to be here with all of you. So thank you very much. I am speaking to the topic. Let me attempt to share my presentation. Okay, so 2025 macroeconomic review and strategic outlook for 2026. Ladi has provided a very good introduction or good background. So I will just share with you the few slides I have here. Well, let me also start by saying that I'm very sure that a number of us must have listened to several reviews that have been done on the economy in 2025 and also outlook. We've seen so many of them, you know. So my approach is going to be different. I'm not going to bore you with charts and tables as we often see in this kind of presentations. I will be going straight to the beef of the presentation, which is what is in it for investors and how should investors play in the market for 2026. Now, 2025 globally grew by 3.2% according to the IMF, and that provided a relatively stable external environment. In advanced economies, we witnessed gradual pivot to less restrictive monetary policies, which of course eased global financial conditions. But of course, in 2025, the geopolitical constant, what has been known now as the geopolitical constant, the Russia-Ukraine conflict persisted, and of course contributed to some volatility we saw in the oil price. You recall that the 2025 budget for Nigeria was based on $75 per barrel, but the volatility we saw in the market last year didn't allow it to stabilize around that price. Now, the easing of global financial conditions in 2025 was, of course, favorable for emerging markets, including Nigeria. And that's why we also saw some huge inflows, relatively huge inflows into emerging economies, including Nigeria. Now, back home, 2025, we saw GDP growth rates accelerating to 3.9% by September of 2025 from 2.7 in 2024. GDP growth rates for 2025, has been was positive and relatively fairly, strong. We also witnessed moderation in inflation rates, as rightly mentioned by Ladi. Inflation moderated to 15% by December of last year. Monetary policy was tight overall. The MPC maintained MPR at 27%, which of course we know is relatively high. But we saw improvement in external reserves at over $45 billion, enough to finance more than 10 months of imports. Naira stabilized in the main, again on the back of rising external reserves, on the back of the reforms that are still ongoing in the forex market and all the policies measures introduced by the central bank to particularly check speculation. The exchange rates in 2025 also strengthened. The budget benchmark was 1,500 Naira to the dollar, but we also saw that before the end of December 2025, the exchange rate was below that officially, and the parallel market premium also narrowed between the official and the parallel market rates. But as I noted earlier, international oil price performed below the budget benchmark, and the crude oil production. Crude oil production compared to previous years showed an improvement in the wake of reduction in pipeline vandalism and some also new investments in the oil sector. But again, the magnitude of the increase was below budget benchmark of 1.84 million barrels per day. So as I noted earlier, portfolio inflows surged by over 800% to 1.12 trillion, driven by renewed investor confidence in Nigerian assets. The performance of 2025 was also enabled by improved regulatory environment. We saw the ISA 2025, November last year. We also had a transition or improvement from T+3 settlement cycle to T+2 settlement cycle for the equities market. And a number of banks succeeded in meeting the capitalization requirements set by the central bank. As a matter of fact, over 2.5 trillion fresh capital was raised from the market. Now, doing a bit of deep dive with respect to market performance in 2025, we saw the star performer there, consumer goods sector. Consumer goods sector as the star performer by over 100% year-to-date return on the back of easing forex losses. Of course, in 2024, we saw many of them, the likes of Cadbury, Guinness, posting huge forex losses, but that wasn't the case in 2025. So that helped them perform better. These companies also maintain their pricing power. Of course, many of them deal with goods that have inelastic demand. So when you are dealing with products that have inelastic demand, of course, it means you have, to a large extent, control over the price. So top performance include Guinness, Champion Breweries, Honeywell Floor, and we also have heavyweight contributors from Nigerian breweries, Unilever. These posted impressive returns. Another sector that beat the market. When I say beat the market, I mean outperformed the market. You recall that the market, when we say the market, we mean as proxied by the all-share index. The all-share index gained about 50%, 51%, 51.19% in 2025. But we also have sectors that outperformed the average. I just mentioned consumer goods that posted over 100%, and another one is the insurance sector. Insurance sector gained 65.6%, catalyzed by partly by the Nigerian Insurance Industry Reform Act, which was signed into law mid-2025. And then that industry is also witnessing recapitalization, driven balance sheet strengthening. And some of the leaders in that sector include sovereign trusts, IECO, NEM Insurance, that did very well in 2025. Another sector that outperformed the markets, again, recording more than the 51% average, is the industrial goods sector at 58%, driven by strong construction demand and stock-specific re-rating. We saw an exceptional case in Better Glass by over 470%, year-to-date return. Of course, supported by some cement firms. So what clearly comes out is that the performance of the markets in 2025 was not just one sector driven. Unlike before, you wouldn't talk about market concentration. In the past, it used to be maybe the banking sector would do well and then draw, change the narrative. the bellwether, if you like. But this time around, performance appeared to be broad-based. Broad-based, we saw consumer goods, we saw insurance, industrial goods, including even the banking sector. Although the banking sector underperformed the market, it didn't beat the market, but it showed positive growth, positive growth that is also real. So real return from the banking sector was positive in 2025 in the sense that it's higher than inflation rate for 2025 at 39.8%. And this was achieved despite regulatory headwinds and dividend suspensions, or the CBN forbearance directive. Because investors in 2025 were actually looking beyond the near-term constraints to the transformative recapitalization that was going on. We know the number is more now, but at that time, 16 banks had raised over 2.5 trillion ahead of the March 26th deadline. So the implication for the market was that the sector was re-rating on future strength, not current earnings. And we are likely to also see much of that in 2026 this year, as we shall see shortly. Now, in all of this in 2025, the lone laggard, if you like, was the oil and gas sector, largely as a result of subdued and volatile global oil price, stock-specific operational challenges, global demand uncertainty, and geopolitical overhang. So we saw that capital actually was flowing into the market, but flowing to reform beneficiaries, more or less, away from the oil and gas. Now, who do I consider the winners in 2025? I have put them in several buckets, several categories. The first category, those who invested in consumer goods equities. Guinness, Nigeria, Vitafoam, Champion, Honeywell, NASCOM, Nigerian Breweries, Nestle, Unilever. They won because these people recognized the potentials in these firms and then began rotating into these firms early enough because they focused on companies that are able to pass cost to consumers. I talked about companies that are able to maintain pricing power. These are the ones that won. Another winner in 2025, the financial services sector, banking and insurance, also won. And they won on the back of anticipated balance sheet strengthening. I can say that the recapitalization exercise by the Central Bank of Nigeria and the NICOM, had positive impact on the performance of these firms in 2025. Investors too, who had long-term focus, despite the near-term, the regulatory issues, they are the ones that won in 2025 because they positioned ahead of the capital raises and the recapitalization rating. Another group that won, investors in industrial goods and construction-linked stock. Better glass, cement majors, building materials producers, they also smiled to the banks in 2025. And why did they win? They won because of a careful stock selection within industrial names, targeting companies benefiting from domestic demand and infrastructure expansion. Of course, as I noted earlier, those that lost actually were those that stayed underweight equities. They failed to price in the reforms. They were those that were skeptical about the reforms and did not take positions in equities in 2025 were the ones that lost the over 50% return that the market made in 2025. 51.19% was lost by these people. Now, having looked at 2025, the winners and losers, why they won and why they lost. What's this year going to be like? I had done an article earlier that was published in many dailies on 1st of January 2026, which I titled Crystal Gazing the Nigerian Stock Market in 2026. And much of what I said in that article, I'll be repeating here. But we also know that recently from the World Economic Forum that just ended, a major risk was identified in 2026. And that is the risk of cooperation in a fragmented world. Cooperation in a fragmented world. That's the major risk, the risk of protectionism, unilateralism, and the likes. So for 2026, IMF is projecting 3% growth global, but that will be, of course, that we know that's on the average. But we also know that for Nigeria, IMF has projected 4.4% growth rate. So basically for emerging economies, you're likely to see, going by IMF prediction, higher growth rate than for developed economies. That has been the trend for obvious reasons, base effects and the likes. So for investors, what are the things that should be of interest to investors? The first is what I mentioned earlier: rising protectionism and trade wars. Reshoring trends continue. Instead of going to produce abroad, you find people now coming back home. The US in particular is doing reshoring, being promoted strongly by Trump. So one implication of that is supply chain efficiency. Investors should watch out for EU-US tensions. They should watch out for BRICS trade bloc developments. And they should also watch out for gradual de-dollarization in trade corridors, offering new currency hedging needs and opportunities in local currency bonds. The Russian-Ukraine war is also there. It will continue to remain an issue in 2026. And to that extent, we'll continue to put pressure on European energy and global food, food supply chains. There is what is now known as the arc of instability. The arc of instability is issues around Venezuela, Iran, and Greenland. We know, again, that Donald Trump has been threatening to impose tariffs on countries in relation to the arc of instability, in relation to Greenland, Iran in particular. So that's going to make commodity prices volatile, especially for oil. As a matter of fact, the prediction for oil in 2026 by a number of reputable energy agencies is between $60 to $65 per barrel for 2026. Now, globally, to monetary policy shifts from rate tightening to rate normalization in both advanced economies and emerging markets. So we're likely going to see in advanced economies more of rate normalization, particularly in Europe, and then even lower rates in the US. And that brings me to the next point, which is very, very important, and which I want, something I want investors not to lose sight of or to take into cognizance. We all know, we have read that the US Federal Reserve chair will be completing his tenure, Jerome Powell, completing his tenure in May of this year. And President Trump has nominated Kevin Walsh as his replacement. Kevin Walsh is a known critic of the Federal Reserve. And Kevin Walsh is somebody who the markets believe. Dr. Bayo, can you please mute? Yeah. Kevin Walsh is someone who the markets believe will be more amenable to Donald Trump's influence over the Federal Reserve. The Federal Reserve, yes, will continue to be legally independent, but we can be sure that the market will price in a higher probability of a more accommodative or dovish bias under the new leadership at the Fed, under Kevin Walsh. So for monetary policy direction, there's likely to be heightened expectations for rate cuts in the US, which of course would be conform with what Donald Trump has wanted. It has implications for inflation and the dollar, the US dollar for 2026. So if eventually we have a politicized dovish Federal Reserve, you can be sure that inflation rate in the US will cross the 2% target of the Federal Reserve. And higher inflations in the US, of course, also have implications for developing economies like Nigeria that import so much from the US. It's also going to have an impact on the US dollar because lower interest rates usually tend to weaken the dollar, the US dollar. So relative to the euro, for example, we should expect that if Kevin Walsh assumes office and begins to toe the line of accommodative monetary policy, the US dollar is likely to weaken compared to other major foreign currencies. So that also has implications for dollar-based investments. Okay, so strategic implications for investors. How should they position? Okay, my suggestion here is, if that is likely to happen, then the response should be to underweight the US dollar. You hedge USD exposure and consider allocations to currencies of economies with more orthodox central banks. So you underweight US dollar and pivot to the euro and the pounds. Another implication is that, or rather how to position, is to reassess duration risk. A dovish pivot means longer duration US treasuries, attractive for capital appreciation, but of course it's coming with its carrying inflation premium that may be priced into yields over time. For international investors, the advice to favor emerging market equities, because looser dollar liquidity is a classic tailwind for emerging market assets. So increase allocation to emerging markets like Nigeria that offer high growth and sensitive and are sensitive to global capital flows. Now, for Nigerian and international investors in the Nigerian market, a weak USD, of course, also has implications favorable for Nigeria. It's going to reduce external debt service pressure. And it's also going to encourage stronger foreign portfolio inflows into high-yielding Nigerian assets. That will help to support Naira stability by improving Naira-denominated investments. Now, in terms of sectors, again, remember when foreign investors come in, they tend to also come into some sectors, one of these sectors is usually the banking sector. That's why if we are likely going to have more increased capital flows as a result of lower interest rates in the US, it means that it will be advisable for any investor to overweight banks. And high growth stocks, because these firms are usually beneficiaries of increased liquidity and risk appetite. That is what the trend has shown. Okay, when it comes to whenever you have increased liquidity, these are the firms that are beneficiaries. Okay, so for a fixed income strategy, avoid over concentration in long duration US bonds. Prefer short to medium duration instruments. Obvious reasons. Now, select emerging market debt with strong reform credibility, example, Nigeria. And of course, monitor inflation-sensitive sectors. If US, for example, fuels global commodity inflation, as I told you, as I mentioned, if you have high inflation in the US as a result of lower Fed fund rates, okay, it means that the the oil sector, for example, global commodity, the upstream oil and gas and certain commodity producers could see a rebound when you have higher inflation in the US. So in the light of this, what should investors watch out for? From now on, Jerome Powell's tenure comes to an end in May. Kevin Walsh is likely to take over. So from that point onwards, you should watch out for confirmation hearings and testimony. Okay, statements made by Walsh that will give us clue as to his true independence, versus political accommodation. We should also watch out, investors should also watch out for the first Federal Open Market Committee meetings, their decision, our equivalent of the MPC here. They should watch out for the first one, okay, and the decision, the speed with which the initial rate calls will be made will signal the direction, really. They should also monitor inflation, US inflation data, okay, and watch out for any signs of re-accelerating. And of course, the dollar index. Always watch the dollar index and the US 10-year yield, again, for clues as to how to move, how to position. Another important aspect of the global outlook in 2026 is the oil market, what I call the oil market reality. If you look at the forecast range, whether you're talking about the International Energy Agency, OPEC, Bloomberg, they all talk about 60 to 65% range. Okay. Okay, excuse me. Okay. Now, this is going to be as a result of slowing global GDP growth and accelerated electronic vehicle adoption in key markets. Now, sustained high output from US shale and non-OPEC plus producers. Increase in output will lead to a fall in oil price. Yes, I had acknowledged earlier that a weaker dollar is in the offing. A weaker dollar as a result of potential Walsh Fed policy is likely to provide some support, but that will be outweighed by fundamentals. Now, what are the implications for global and domestic investors? Of course, for exporters like Nigeria, if you look at our 2026 budget, we are using 64.85 dollars per barrel. That's more like the very top range of what they are forecasting. So you can see the risk that is already there. And that's why the other day, I think somebody was saying that Nigeria should, the government should, look at the budget again so that it can reflect reality. What is clear is that the era of $80 per barrel oil is over, at least for in the very near future. So how should investors in Nigerian assets play this? Now, lower oil prices mean increased domestic borrowing. We know that already in the 2026 budget, we have 24 trillion naira deficit. 24 trillion. So if government is going to borrow more, that will lead to higher bond yields and potential crowding out. There will also be pressure on external reserves if oil prices drop and we are not earning enough revenues. So what you should watch out for is the central bank's ability to defend the naira, amid dwindling petrodollar inflows. So for foreign portfolio investors, investments in ICT services, agri-processing, that are critical. Positioning in these in these sectors, will show proof of diversification. And for domestic institutions, anytime weak oil price is sparking a sell-off, that is the time. That's the time for a rational investor now, a knowledgeable investor, to accumulate, quality non-oil stocks at a discount. So that's the time to actually go in. Now, in 2026, what are the tailwinds? What are the things I consider as tailwinds in 2026? Moderating inflation. Central bank is determined to ensure that inflation doesn't go beyond what it is now. We hear 12% range. Exchange rate stability from what we can also see, central banks, with the governor's body language, the central bank is willing, with the kind of reserves they have now, to also defend the naira and maintain exchange rate stability. I also think tax reforms will be favorable will be a tailwind for the economy and for the market. Particularly the waivers we hear will improve disposable income, not only for individuals, but also investable income for small firms that can serve to increase demand. If demand for goods and services increase, of course, it will favor the firms that are listed on the exchange, their bottom lines. I also think listing of Dangote Refinery is a tailwind. A lot has been said around this, especially by the group chairman of the NGS group, how it will bring about favorable outcomes for the market. Banking and insurance sector recapitalization is also tailwind. Then headwinds for 2026, watch out for pre-election spending. Insecurity is still there, still around, but I'm happy that the government is committed to dealing with insecurity. Now, fiscal slippage and rising debt service. Debt service in 2026 budget is put at 15 trillion. 15 trillion. So that's huge. Okay. It is going to be more if, for example, we have fiscal slippage, if revenues drop, oil revenues drop in particular, and government borrows more. Of course, that means deficit will be higher, and debt service will also be higher. So what's the strategy, particularly for political timing? So what I advise here is that around when INEC releases their timetable, for example, one timetable is out for the timetable for elections, investors, traders should be very wary around the primary time. So you monitor the primaries when it's about primaries, because that's usually when you have, it's going to start by that time. Okay, so that will also determine the kind of move you make. So that is not the time to be involved in any speculative position. So likely winners in 2026. Here I say, just as I noted earlier, 2025 it was a broad rally. 2026 may be selective alpha. 2025 was driven by what? Reforms. 2026 was driven by earnings and balance sheet driven markets. So 2026 will be more of fundamentals now. So that is what should count. Again, I've boxed them into categories. Consumer goods companies are likely to win. So I can bet on this because the same factors I mentioned earlier, pricing power, strong cash flows, local sourcing, especially now that a number of them, have begun to recover. So these companies usually benefit from moderating inflation. Okay, they usually benefit from lower fixed income yields, which encourage rebalancing. because we expect that this year, central bank will also soften somehow. I don't see central bank maintaining monetary policy at 27%. So if interest rates are going to come down gradually, it means yields, also fixed income yields, are likely to drop, and that will favor, you see, investors rotating to equities. So when you are rotating, rotate to high return on investments, companies with strong margins, and companies with forex resilient balance sheets. Another category will be banks completing recapitalization. Now, from the little research I've done, I can tell you that some of our banks are already underpriced, undervalued, and I see them doing very well in 2026 post recapitalization. Okay, after March, of course, but the time to actually go in is now, because after March, you're going to see many of these banks doing well. Second quarter, third quarter, by the time their earnings coming, first quarter earnings coming, second quarter, they're likely to do well. So they are going to do well. Why will they win? They win because of earnings normalization and re-rating post uncertainty, because they will have finished. For many of them are out of the central bank's forbearance regime, and many of them too have met the recapitalization requirement. So the next phase for them will be, growth. So banks are likely to be among the winners in 2026. Another category will be the category that will be benefiting from any successful implementation of the 2026 budget. If we go by what the president said during his budget speech, that they're going to make sure that 2026 budget will be better implemented. Okay, they are paying more attention to capital allocation. Capital vote in 2026 budget is 26 trillion. The size of the budget is 58 trillion, out of which 26 trillion is for capital. And the president has assured that there will be no more rollover. So this issue of not completing the project and taking it to the next year's budget, the president has said it has come to an end. So I want to believe that some of the companies that are tied, that have a lot to do with the budget, will benefit. Industrial goods, for example, are also going to benefit. So what it means is that if you're investing, you're favoring companies, firms with government-linked contracts, if you can get them. That's why you have to do your research. Firms with government-linked contracts and firms that have strong execution track record. Another group of winners, the digital and AI adapters, will also win. Financial institutions deploying AI for credit, fraud risk, asset managers embracing data-driven investing. They will all be winners in 2026. And why will they win? AI improves cost efficiency, risk pricing, customer acquisition, and we know digital assets attract, more younger people and more capital. Generally, countries adopting AI, faster attract capital. So I will end by talking about what I call the investment playbook in 2026, the do's. What investors should do in 2026. For institutional investors, pension funds, DFIs, insurance, they should prioritize capital preservation with real returns through a blend of high-quality fixed income and selective growth assets. They should back reform beneficiaries. When I talk about reform beneficiaries, I'm referring to these companies or firms that are already undergoing reforms within their sectors: banks, insurance companies, infrastructure, energy transition, digital economy. Institutional investors should also increase their exposure to real assets, infrastructure, energy, and of course, always stress test portfolios against forex volatility. Foreign investors should take advantage of valuation resets, maintain forex risk discipline, adopt a medium-term horizon. foreign investors should adopt a medium-term horizon rather than short-term trading. Of course, they have to do this. We know this capital gains tax of 30% that says once you're selling, you're making a gain of 10 million, or you're selling shares worth 150 million naira and above, that you are to pay 30% tax. But you are also exempted if you reinvest. If you reinvest the money. So that means there is no tax on it at all, except you're pulling out. And that's also why it's important to adopt the strategy of a medium term as opposed to short-term trading for foreign investors. Domestic and retail investors should stay invested, but selective. Blend yield assets with growth. Yield assets are those assets, those companies that give you, steady cash flows, but you don't have to just focus on those ones. You also maintain with the ones that have the potential for growth. Now, what investors should not do in 2026, they should not chase momentum blindly in overheated assets. Avoid over-concentration in a single asset class or sector. Do not ignore global risks. Always monitor US monetary policy, geopolitics, and oil. They are still important. Avoid excessive leverage in volatile macro environments. And do not confuse policy headlines with fundamentals. So what matters is actually fundamentals, not just the headlines. So my closing, I would say that this year, 2026, will still remain a VUCA world, in the sense that we are still going to have the volatile, uncertainty, complex and ambiguous, but of course not in the same degree as we had in 2025 and 2024. Okay. 2025 was a year of reforms, which I mentioned earlier. 2026 is a year of positioning, and alpha will come from positioning, not participation. Alpha is simply that return that beats the market. So if you want to beat the market, win alpha, you position very well, not just by participation. And earlier on, Ladi talked about noise. Yes, cutting out the noise. The best way to do that again is to position yourself, very well. So on this note, I want to say that last year I talked about the DHL approach. This DHL is something I coined. DHL stands for diversify, H is hedge, L is long term. So my DHL advice remains timeless. Diversify, hedge, and think long term. The chairman of this webinar series, former chair of FIRS, Dr. Nami, our group chair of NGX, and the MD CEO of ASAMs, and every other distinguished person here. I want to thank you for your attention.
Thank you so much, Prof.
Well done, Prof.
That was an incredible one there.
Correct, Ladi. Correct, Ladi.
Dr. Kwega enjoyed it very much too.
Thank you.
Everybody else.
Highly impressed.
There's no opportunity for standing ovation in
correct.
You
have done that.
Yeah.
Correct. Well done.
That was fantastic. Thank you so much, Prof. So just a quick recap there. Prof unpacked a whole lot, and definitely I feel armed, going into 2026. At this point, I hope you also feel the same way. He did talk to us about the playbook for 2026. DHL, diversify, hedge, and think long term. He also talked about the risk in 2026, risk of protectionism, unilateralism, and the global growth outlook for GDP there. That's about over 3% from the IMF. And definitely we cannot shy away as investors from what's playing out in the geopolitical space. We're seeing the way things that we used to call stable, assets that we call stable, safe haven, see them having big swings of 15% down, 8% up, likes of silver, gold. So definitely these are interesting times, and we need to be armed with the right information. Thank you again, Prof, for that presentation. It's definitely going to give us is giving us an insight on what to expect in 2026. And since we've been able to scale through 2025. So right here in this gathering, we have some really important personalities with us. I can't mention all the names here, but we have really big minds when it comes to finance, financial services, and definitely in government and all of that. But I would also like to hear some words from Dr. Kwairanga Umaru as the chairman, NGX. Definitely, we did hear from Prof there. Prof talked about the winners of 2025, consumer goods, over 100% rise. We have the banking sector, a lot of stocks doing over 1,000% profit and the like. So, Dr. Kwaranga, I would like to hear a few words from you on what to expect of the NGX in 2026.
Okay, thank you very, very much, Ladi, for this opportunity. Good afternoon, all. I will first of all want to commend my late brother, Tunde Amolakbe, MD of Auto Stephen Asset Management, for organizing and hosting this macroeconomic review. Honestly, ladies, this type of discussions are important for the market participants to take stock of what is on ground and better plan for a pre-election year that may be likely be turbulent, as been stated by Prof. Let me assure you that today the speaker have said a lot, and for us at the Nigerian Exchange, in our usual proactive manner, we have listened attentively, and we are going to work on these useful suggestions that will improve our capital market in the year ahead. I want to assure you that for us, we are all into this. We are very hopeful that this year is going to be better than last year, despite all the risks being associated with the issue of the economy and the issue of the election in particular. For us, we have the resources, we have the capacity, we have the operators that we can be able to move this economy forward. We have doubled our market capitalization last year. We are likely going to not only double, triple it this year. We have some very big transactions that are coming up. In addition to what the Prof have mentioned, like the conclusion of the banking recapitalization by most of the banks, the insurance companies that are coming, and even the bigger one, the state-owned enterprises, in addition to the game changer, the Dangote refinery. We are thinking of Dangote fertilizer, but I want to reassure you today that we are coming with the Dangote refinery before the end of April. And that will go a long way in improving our bottom line. That is the talk that we have been doing. That's the plan that we are doing, among so many other listings. So thank you very much for this opportunity, Ladi. I believe all the market operators that are here and all the stakeholders in this market, we are all together into this, and we are very, very hopeful of this year. Thank you very much, Ladi. I appreciate.
Thank you so much, Dr. Kwaranga Umaru, the chairman, NGX, and definitely I feel optimistic about the growth of Nigeria's stock markets. Quite a stellar performance, in 2025. And 2026 is looking like it will toe the same line. Or even better.
Excellent.
Fantastic. Thank you so much, sir.
Thank you, Ladi. Well done. Thank you.
Yes. Yeah, so definitely we're going to be getting questions from participants here. You can always type your questions in the chat box, and definitely we'll read out those questions. And also, you can also signify by raising your hands if you want to ask a question. And right about now, we're going to be moving along. And I told you earlier that we have really special people here with us today. And right about now, to take over, presentation here and tell us what to expect in 2026 as it relates to tax. Like, I can't go a day in Nigeria now without talking about or hearing, about taxes. It's something we're all talking about right now, and even salary earners, everybody's watching out, for their salaries at this point. What's the big change, with the new tax law? So please, I'd like to make welcome Mr. Mohammed Nami, the immediate past executive chairman of Federal Inland Revenue Service. He will help us make sense of what's playing out with Nigeria's tax laws in 2026. I'm just going to read out his profile now. Mr. Mohammed Nami is the immediate past executive chairman of the Federal Inland Revenue Service, serving from 2019 to 2023, where he led sweeping reforms that modernized Nigeria's tax administration. With nearly 30 years of experience in accounting, auditing, management, and tax advisory, he strengthened the agency through automation, improved taxpayer engagement, cooperative compliance, and restored operational stability. During his tenure, he also chaired the Joint Tax Board, the African Tax Administration Forum, ATAF, and served as president of the Commonwealth Association of Tax Administrators, elevating Nigeria's influence in global tax policy discussions. A graduate of Bayero University, Kano, and Ahmadu Bello University, Zaria, Tsunami holds multiple professional fellowships and memberships across Nigeria's leading tax accounting and management bodies. He began his career at PFK, later founded Manam Professional Services, and has interests across agriculture, power, real estate, and consultancy. After completing his public service role, he furthered his leadership training at Harvard Kennedy School, earning executive certifications in 2025. Please, ladies and gentlemen, please help me make welcome Mr. Mohammed Nami. Great to have you, sir. And Happy New Year, sir.
Thank you very much for having me, and Happy New Year to you too. I've earlier shared my slide with the photo, the host of this program. So Mr. Olatunde is already sharing it. You shouldn't expect to hear from me about all the things you listed in the course of the opening remarks. I'm only going to talk to the investors that are present here. The tax reform has been a very daunting one, but there are several interests in it, so I'm going to be a bit professional and a bit careful in only trying to lead us through what is obtainable here today. Thank you so much. Let's start so that we save time. The title is, as has been rightly projected, the overview would be to look at, in the first place, why did we even carry out the tax reform? What was obtainable before the tax reform happened? What has changed? And what are the actual laws that have been passed? Another key issue that should interest everybody is that the implication that these changes or the laws that have been passed have on capital market. There are some underlying controversies. We'll diplomatically look at them, and then together chart a way forward. In other words, how do we fix these controversies? Next slide. Why the tax reform? While I was at FRS, you recall virtually every year at the point of annual budget review by National Assembly, the federal government will suggest certain tax reforms. And it became clear that because certain provisions of tax administration in Nigeria are domiciled in the FRS Establishment Act, our Establishment Act was exposed to National Assembly and to public for scrutiny on an annual basis. So we decided to say, what do we do to avoid this? At the both management and board meeting, let's carry out a comprehensive reform so that we sieve out the tax laws in our Establishment Act, take them to where they rightly belong. And that is why the issue of harmonization came in. The second reason was that some of the laws were made in 1960s up to 1970, and they were absolutely inefficient, leading to tax evasion and creating administrative problems for us. One of such examples is that you have law that was denominated in kobo, and there is nowhere in the country where transactions are done in kobos. So we felt that shouldn't be. Reforms also under the current president requires that they make some money to fund some critical infrastructure project. Another reason is to shift burden from low-income earners to high net worth individuals through progressive tax system. The last point that we consider at that point was our tax to GDP ratio was fundamentally low. I made it at 6%, left it at 11%. So we felt something should be done in order for us to be able to move the tax to GDP ratio to certain fundamentals that will reflect the African average or the international average that is obtainable globally. Next slide. So what was obtainable before the tax reform? This time around, we're looking at capital gains tax. We are not talking about the entire provisions that were obtainable before the tax reform. We are specifically talking about capital gains tax and as it affects the business that we do here. Before now, we usually have flat 10% capital gains tax if you sell chargeable assets, e.g. shares, bonds, and land. Then again, from security listed on the Nigerian Stock Exchange were mostly or often exempted from capital gains tax. There was no minimum threshold applied to most of the disposals. So there was also weak enforcement on the part of the Revenue Authority, as a result of that, there was low compliance because of manual processes that was obtainable before. Before I even assumed office as the chairman of FRS, and even at the point I was leaving in 2023 December. Next slide. So how the 2025 reforms, what are the post-reform shifts? The 2020 reform attempts to expand the tax net to include modern asset classes and progressive rates. And one of the ways that happens is that the law has not been able to include digital assets, cryptocurrencies, and foreign investment as part of the chargeable asset. The law now have also introduced progressive capital gains tax rates, now introduced for high value gains. The law has now encouraged e-filing and real-time reporting to reduce tax evasion. The removal of some exemptions too, potentially increasing transaction costs but improving transparency. Next slide. So what are those the key changes proposed and what actually really happened? So there are some specific rate adjustments and monetary threshold defined in the 2025 tax reform proposal. If gains are beyond 500 million, the rate applicable is between 15 and 20%. So the rate has now been increased from 10% to 15% for gains that are above 500 million. And for smaller investors, earning or gaining less than 1 million, they are completely exempted from paying capital gains tax. Then if there is nominal increment, adjustment for gains for inflation is provided to avoid taxing nominal increases. So until there is actually gain, the 15 to 20% is not going to apply. Next slide. Please move to the next slide. Okay. The actual laws passed. Nigeria Tax Act 2025 consolidate previous tax laws, including the Capital Gains Tax Act, into a single framework. Capital gains tax is now integrated into the income tax system, moving away from the standalone tax. And then Section 35 of the Nigeria Tax Act 2045 provide for disposal is only triggered. If disposal is now what trigger capital gain tax liability. And these disposals include sales, transfers, other realization value. Company income tax for companies. For companies, maximum rate is 30%. Standard rate for companies income tax is reflecting a significant increase from 10% rate. Then for individual and in line with the personal income tax rate, the maximum rate is 25%. And for small companies, just like I stated earlier on, for companies whose disposal or gains are below applicable to companies with turnover of 100 million and fixed asset of 250 million, the rate still remains zero. This is to the future. Then there are certain exemptions and investment reliefs. These provisions were designed to encourage retail participation and capital investment in Nigeria. One of those exemption and relief is gains from selling shares in Nigerian companies are exempt if sale proceeds are less than 150 million and the chargeable gain does not exceed 10 million within 12 consecutive months if the shares are transferred between approved parties in a regulated market. Then wire proceeds also are reinvested in Nigerian company, the threshold does not apply and the entire investment amount shall be exempted, while the sum not reinvested shall be subject to capital gains tax. Exemptions also apply to pension funds, private residences, and low value. So the reform also make provision for capital, digital compliance and withholding. Asset disposal, the disposal of the shares on the Nigerian export is, like I said before, triggers tax liability, and there is a mandatory requirement for source deduction for share disposal on Nigerian exchange, the Nigerian exchange. Then there is a provision for digital reporting, real-time reporting, and filing via digital compliance platforms integrated with the FIRS. Then the last process is verification, which is enhanced enforcement via automated cross-referencing of transaction data. So what are in the implications on the capital market? That is how the reforms drive transparency, stability, and innovation in Nigerian financial sector. It has brought about increased transparency, digital innovation, which include digital asset, integrates Nigeria's growing crypto market into regulated finance, potentially fostering innovation. Then the last one is retail participation, which provides for exemptions for small disposals and reinvestment to encourage retail participation and domestic capital retention, thereby promoting mutual depth and stability. Next slide. The reforms also discourage speculative trading by promoting long-term investment through hard period incentives, e.g., lower rates for assets held above 5 years. It taxes wealth accumulation and attempts to reduce inequality. Revenue investment in infrastructure, potentially growing the capital market. Then the reforms aim to boost government revenue, projected at 2.3 trillion naira annually, and it's also going to give us opportunity to align our performance or tax processes with global best practice. The rate hike to 30% for companies could deter large institutional investors, reducing after-tax returns and liquidity on the exchange. Market reactions in 2025 included an 8% dip in the exchange all-share index during debates. This single act signals risk for capital flight in the future, especially from foreign portfolio investors. Indirect transfer taxation may also complicate cross-border deals, and which has serious impact on mergers. And then SEC NGS, and Charter Institute of Stockbrokers argue for phased implementation, will lead into some of the proposals, e.g. the unrealized gain drop due to outcry. Next slide. Then what is the way forward? So that with the first one that came to my mind is there should be annual review, just like we are doing through finance bill by National Assembly to adjust rates based on market performance. Then there's a need for stakeholder collaboration. Nigeria Revenue Service is expected to collaborate with the NGX, Security and Exchange Commission, and other critical stakeholders for investor education campaigns. Then the last one that I suggested is that there should be incentive innovation. Efforts should be made to introduce tax credits for green investment or IPOs to offset capital gains tax impacts. Thank you. That is just the little presentation I have. I feel I should not do so much talking so that eventually we do not open up wounds that are already healing. But if there are questions, then we should be able to.
Thank you, sir.
Yeah.
Thank you. That was a very interesting presentation, sir. Mr. Mohamed Nami, the immediate past executive chairman of the FIRS, and definitely talking about how the tax reforms impacts the capital markets and investors. Thank you so much for that. So that was a very enlightening one there, telling us some of the thresholds, when it comes to transactions that would actually require the capital gains tax. 500 million and above, I believe, attracts 15 to 20%. And definitely, I'm sure there are a couple of us in here that make those kind of transactions. And definitely we have the ones below 1 million exempted. So, definitely it's there's some good vibes there, technically when it comes to, the capital gains tax. And, I guess you can also just decide to hold. You don't have to sell or take profit. You hold like 5 years, and I guess you'll be exempted, from that tax. Thank you again, sir, for helping us unpack all of that and the expected impact for investors and the capital markets, and definitely your recommendations there for tax incentives. It's not all about taking those taxes, but it'd be nice to also get some incentives, to encourage people to pay their taxes. Thank you again, sir. So still stay with us, Mr. Nami and Professor Uche Waleke, because we're going to have a question and answer segment at some point. I know that a couple of us here have questions, and definitely you can put the questions in the chat box, and at some point you can also raise your hand if you have a question to ask, and you try to make your questions as brief as possible, because we don't have that much time, but we'll try to do as much as we can with limited time. But at this moment now, I'd like to also make welcome the former president of CIS and the MD at the Stevens. Is a renowned investment banker, asset manager, and stockbroker. Mr. Latside Amalegbe, my oga there, is going to help us unpack the 2025 financial market review and give us an outlook, what to expect in 2026. Where should we stash cash in 2026? Which asset classes are going to be the winners? He'll help us unpack all of that right now. Then after that, we'll now have a question and answer segment. Mr. Amolabi, are you ready?
Yes, thank you very much, Ladi,
you have the
for
floor,
that
sir.
time. Yes, thank you so much
Thank you,
for
sir.
that kind introduction, Ladi. Again, let me use this opportunity to welcome and at the same time thank all our special guests that have taken the time to spend this afternoon with us. Professor Walike, we appreciate you so much. Alhaji Mohammed Nami, we appreciate you for finding the time to spend this afternoon with us. I mean, like as you mentioned, this issue around tax have stopped from being a physical issue to also becoming a political issue. So it is important, and it's a critical issue that we honestly need every voice to speak up on that particular issue in our country at this particular point in time. So we thank you for finding the time to really add your voice to the discussion on that particular issue. Because our time is well spent, and I would very much like for us to be able to take your questions. I will try and shorten my presentation, and also because, of course, I realize that Professor Onwalike have also spoken a little bit, quite significantly, to some of the issues that I will be speaking to. So my presentation will not, will as much as possible not seek to repeat what he has spoken to. So I will go straight to trying to discuss the overview of the financial markets in 2025. Then now go ahead and speak to what we perceive as the outlook for the financial market in 2026. So I'm going to start with the equities market. As Prof has mentioned, 2025 was an headline year for the Nigerian equities market. The All-Share Index did 51%. But beyond that headline cumulative gains, we saw some counters did exceptionally well. Some, recording gains in excess of 200%. And as I've been mentioned, the major gainers were actually from the consumer goods sector and the industrials. And some can argue that, maybe their gains is coming from the fact that, if you look at 2024, those two sectors were also the ones that brought the brunt of the policy changes we saw in 2024. So the two sectors seems to be coming from a low base. But having said that, it can be argued that those that were smart enough to have taken positions in those sectors in 2025, did exceptionally well for that year. And so the graph we can see on the screen demonstrates the yearly performance of the NGX from January to December 2025. And beyond just the gains that we saw on the broad index, we also saw increased participation. And the increased participation is demonstrated by the increase in value and volume that we also saw on a month by month basis throughout 2025. I can remember that we had the CEO of Nigeria Exchange Limited joining us for our half-year review and outlook, and he mentioned that the exchange was coming from a situation where the market was doing something in the region of 2 billion turnover a day, to a situation now that the daily average is now something in the region of 7 billion. So that's like a threefold increase in daily volume, and that's quite impressive. And so that's what this was showing. And if we break it down further, we saw that aside from retail investors coming into the market in numbers, we also saw increased participation by foreign investors. And Professor Walike has alluded to this. The policy changes regarding exchange rates had led to inflow of foreign investors, and most of them, while the bulk of the foreign investors, typically access the fixed income markets initially, ultimately they find their way into the equities market, and this is reflected in some of the graphs you can see. You can see significant growth in the percentage of foreign investments we saw in the market, and that actually peaked in July 2025, where we saw the highest number of entries by foreign investors into our market. The next graph showed the participation by retail investors versus participation by domestic institutional investors. And it is quite gratifying that, after years of staying by the wayside, we are seeing domestic institutional investors such as PFAs, such as insurance companies, asset managers, starting to show more interest in risk assets such as equities. So this is quite gratifying. Now this slide speaks to what we have mentioned, and what Prof has also mentioned, the fact that on a sectoral basis, we saw a significant overperformance by consumer goods sector, and of course, the industrial goods sector also did pretty well. The insurance sector performance was driven by signing into law of the new Insurance Act by the president. And the general impression is that, the changes made in those laws should help to revamp that particular sector. And obviously, the investors reacted accordingly. So that's why you saw the insurance sector performing pretty well in 2025. The laggards were mainly the banking sector, but then the banking sector is coming from a high. The banking sector was was by far the best performer in 2024, because the policy changes by the government and the new government was seen as favoring that particular sector, and so they are coming from a high, so they can be considered as laggards in 2024. In 2025, the oil and gas sector, one can argue that the deregulation of that sector and the entry of Dangote refinery affected or impacted the oil and gas players negatively for 2025. And I make bold to say that is probably going to continue to be the case in 2026. So what is the outlook? What is the outlook? What's our outlook for equities, or the equities market in 2026? Our expectation is that all factors put together, we expect a bullish run again in 2026. We are positive on the banking sector. We are positive on the consumer goods sector, as well as the industrial goods sector, and as well we expect the momentum in the insurance sector to continue. The oil and gas sector, as I've mentioned, is not expected to do very well in 2026. The telecom sector, maybe because of paucity of liquidity in that particular sector, is expected to be neutral, while we feel that the agricultural sector, despite the positive outlook, appears to be overweight at this point, and we might very well see some level of correction in that sector for 2026. Our expectation also is that we are going to see continuous increase in flow by foreign portfolio investors in the year 2026. just arcing back a little bit to what our predictions were for 2025, just trying to do a little bit of self-assessment here. We had said that we expected inflation to end 2025 at 32%. Of course, that was pre-rebasing. We expected GDP growth rates to close at 3.5%, and we expected the exchange rate to close at about 1,450. We can say with confidence that we were correct in those three macroeconomic indices. We had predicted that the NGX All-Share Index was going to end the year at about 39%, at 39% up. Most of the participants that were with us as at July 2025, when we had our half-year review, we'll note that the NGX All-Share Index at that time was just slightly below 10%. But the NGX All-Share Index eventually closed at 51%. So while it can be argued that we were a little bit far off from where the market eventually closed, but when you look at the fact that most people weren't expecting the market to do as well as we had predicted, 39% was not actually a bad position. And we will argue that these are some of the factors that led to the NGX over performance, which we did not anticipate at the time we were doing our projections then, and that led ultimately to the NGX doing as well as it did. So record capital raising by the banks during their recapitalization, surge in foreign portfolio activities within the year, and of course regulatory modernization via the enactment of the Investment and Securities Act 2025. So those were some of the factors we did not anticipate at the beginning of last year, but which we believed ultimately contributed to the overperformance by the NGX. This slide just speaks a little bit to some of the top performance on the NGX last year. The market was led by NCR that recorded a gain of about 1,354, followed by Better Glass, and followed by Mikio and Ella Leaks. Of the top performance in last year, it can be argued that only Guinness and Vitafoam can be classified as blue chip companies of the top performance last year, which says that at the end of the day, the lowly priced stocks seems to be the ones that are delivering the best returns in the market at the moment. The underperformance were led by VFD Group, and then followed by John Oates, Deep Capital. Sony Insurance is a surprise inclusion in the underperformance list for 2025, because as most of us will note, Sony Insurance actually led the market in terms of gainers last year. Yeah, in 2025, yes. Some key corporate development last year on the market. Total Energies sold a chunk of its Bonga Field holdings. MRS decided to delist, and then we had Tolerance acquiring a majority shareholding in Guinness, and then we had UAC acquiring Chief Foods from the Coca-Cola company. So what are the key determinants of performance for us in Dr. Stephen for 2026? What are the key issues that we expect to drive market performance in 2026? Elevated liquidity ahead of election and strategic portfolio adjustment. We're already seeing it. the first month of 2026, January, the NGX has closed well above 6% this year already. So liquidity continues to flow into the markets, not only from local participants, but foreign participants, and we believe that that will be a key driver of performance in 2026. Major company moves and decisions. So corporate decisions by companies such as Dangote Refinery, Dangote Fertilizers, and their decision to come and list should also be major drivers of performance in the markets this year. Foreign exchange and market stability. This is likely to contribute to improve earnings by consumer good companies and industrial companies, as they are able to start to reduce their finance costs, and their FX revaluation gains starts to appear in their books. Tax and fiscal reforms. So the reforms in tax in the tax law, which was spoken about excessively today, is likely to stabilize government's fiscal position and enable execution of critical projects, which should be positive for most of the companies on the exchange. Improve inflation dynamics and accommodative monetary stance. So as we see inflation start to trend downwards, the expectation is that should ultimately impact interest rates, and interest rates should typically be positive for most of the companies that are listed on the exchange. So all in all, we again at Otto Stevens are sticking our neck out again for the second year in a row, and I'm projecting that the NGX All-Share Index should be able to close the full year 2026 45.9% up, on the back of some of these factors we have mentioned. Our expectation is that the market should, or everything being equal, close up 45.9% this year. So what are some of our well, I mean, this speaks to some of the stocks we had indicated were going to do well in the year 2025, and how they actually performed. We had picked Access Bank, and that counter closed 12%. We had picked GTB, that counter closed 59% up for 2025. We had picked First Old Co. The counter closed 69% for 2025. We had picked Presco, and it closed 205%. So these were the performance of some of the counters we were positive on for 2025. For 2026, this will represent some of the counters we are positive on. MTN, Aradel, Nestle, Presco, Unilever, Okomo Oil, and GTB. For NEM and Dangote Sugar, we feel that we're holding our position on them because we feel that and Honeywell Flour, we feel that they might also be witnessing some repricing very soon. For the fixed income market, as we have mentioned, our expectation is that interest rates will gradually start to trend downwards as inflation continues to also trend downwards. And what that means, of course, is that we will expect that bond yields and rates on treasury bills and the likes will also most likely start to trend downwards. As this happens, we expect that more companies will also continue to access that particular market in order to raise money for their activities. So our expectation is that investors in the fixed income market, at least for the first for the first half of this year, should probably be looking to take a position in long dated bonds with high coupon and relatively high yield, because those are the ones that are likely to deliver significant capital gain to you as interest rates starts to tend downwards towards the end of the year. So what is our model portfolio for the first half of the year? As we have mentioned, we are positive on equities for the first half of the year, and this is reflected in our model portfolio. So we are saying that for the first half of the year, we're expecting investors to increase their exposure to equities. We're projecting that, an exposure to the range of 70% for equities for the first half of the year should be what investors should be looking at, on their portfolio, while they should be targeting about 20% in fixed income and 10% for cash and other alternative assets. All right. Okay, so what are our broad themes for various asset classes for 2026? Before I go to the broad themes, I would direct your attention to the small table by your right-hand side, and it just speaks to some of the macroeconomic indices and what our predictions are for them for 2026. So 2024, we saw GDP at 3%, 2025 GDP at 3.98%. We are predicting that our GDP growth rate will be 4.5% for 2026. Inflation started 2024 at 35%. For 2025, closed at 15.15%. We are predicting that inflation will close 2026 at 13% and below. The MPR, our expectation is that as inflation trends downward and interest rate trends downwards, we expect that the MPR closes below 25% for 2026. So what are our broad themes, for each asset classes for 2026? We remain constructive on Nigerian equities, and we are projecting a base case return of approximately 45% for the year. This outlook is underpinned by stable inflation, stable foreign exchange conditions, expectation of modest monetary easing, and ample pre-election liquidity, all of which historically support risk asset performance. Continuing capital raising activities by insurance companies and PFAs is expected to also provide steady demands for equities, while we anticipate the listing of Dangote Petrochemical and Dangote Refinery also within the year. Regarding fixed income, we remain constructive on Nigerian fixed income assets and project positive total returns for the full year 2026, driven primarily by yield compression rather than carry alone. This outlook is anchored on moderating inflation, improved foreign exchange stability, and expectation of gradual monetary easing by the CBN, which should support declining yield across the curve. Ample system liquidity supported by fiscal spending, maturing securities, and pre-election dynamics should sustain strong demand for treasury bills and FGN bonds, particularly in the mid to long-term range. PFAs and domestic institutional investors are expected to remain the dominant buyers as they rebalance toward duration, rebalance towards duration. So those are our major themes for financial assets for the year 2026. Thank you very much for listening.
Thank you so much for that. That was a very insightful one, and definitely I like the way you also helped us unpack, some of the forecasts when we're coming into 2025, and we also see the ones that hit, and you were spot on a couple of most of the forecasts for 2025, and definitely, looking at the performance of some of your picks for 2025. Wow. So some of them there delivering up to 400, 300% profits, and also your economic forecast for Nigeria's economy. We did also see the laggards there. And some of those laggards are starting off 2026 quite good. Thank you so much, Mr. Olatunde Amolegbe, the MD Arthur Stevens, and our host today. Thank you for helping us understand what to expect in 2026 and taking stock of 2025. Well, definitely, we still have Professor Uche Uwaleke right here, and we also have Mr. Mohammed Nami. We also have Dr. Kwaranga Umaru still here with us. Thank you all for, listening so far and, being good sports and, keeping mute while the presentations were going on. Thank you so much for that. But at this point, I guess we can take a couple of questions. I don't know if you want to put your questions in the chat box, or you'd like to, indicate, by raising your hand, then you can unmute, let us know your question and who is directed to. Let's see. Okay, I will see Dr. Bayo Williams there, thanking the presenters so far. Thank you for that, sir. And, definitely, we're still trying to, navigate, 2026. I know most investors, seeing some of the performance for, most of the stocks listed on Nigeria's exchange there, giving stellar gains, in 2025. And I'm sure most of them will be saying, you know what, I want to be able to pick such winners, in 2026. That's why we're here. That's why we're also navigating. I see Dr. Bayo Williams. I see you have your hands up. Do you want to ask a question? And who do you want to ask the question?
Thank you very much.
Yes.
Thank you, my past president, for putting this together. That's my CIS past president. And thank you, my president of Capital Market Academy, for being the lead presenter. The current capitalization that is going on now, of course, the bank is almost all over. NICOM is there, and PENCOM is there. Yes, NICOM is there, that insurance is there. Now, the really people in the market, the capital market operators, our own is coming. With all this spirit of capitalization, what do you think will be the effect on the capital market itself, on the stock market this year? Because the investors will have to bring in money to support the capitalization of their different banks and the rest. And this may affect the quantum or the volume of capital available to chase other industry, other sectors within the stock market, within the capital market. What do you think will be the effect, negative or positive, of the current state of capitalization program on the capital market this year and beyond?
Thank you for that, Dr. Bayo. I don't know if Professor Uche Uwaleke is able to help us answer that. Professor?
Okay, Professor has to step away because he has another presentation for 4:30.
Okay.
But he has asked that I help to cover his bit.
Okay, fantastic.
All right. Okay, thank you very much for that question, my past president of and chairman of Council of Chartered Institute of Bankers, Dr. Olugbemi is actually the former president of CIBN. And thank you. And obviously, he's also a stockbroker and a market operator himself, as clearly indicated in the question he has asked. And quite frankly, I will just give my own personal opinion on that particular issue of capital raising. You had alluded to the fact that when you raise capital either from private individuals or from the public, obviously the investors expect returns, irrespective of who they are. Investors expect returns, and so I guess the question is that if we raise this capital, is the business there in order to justify the new capital that is being raised? And that, for me, is the 1 billion naira question. And it's left to be seen what will happen post capitalization. However, if I look at it on a broad market view, if I take a broad market view, I will argue that the capitalization by the banks, capitalization by the insurance companies, and capitalization by the PFAs should have an aggregate effect of increasing market liquidity, because obviously a lot of these banks are listed. A lot of the insurance companies are also listed. So the fact that they are capitalizing by raising additional equities or additional shares will mean that those shares will not be available for investors to trade in the market. Also, of course, the insurance companies and the PFAs are buy-siders. They are on the buy side of the market. And the fact that they are also raising additional liquidity to boost their share capital will also ultimately mean that they will have more money, to bring to the market to trade in shares and to buy shares and to invest. So, I would, if I want to look at it on the back of the impact of this capitalization on the market, I will say that the impact is that it ultimately increases the liquidity of the market, which I will argue is a positive thing, because most of the foreign investors that are seeking to come to Nigeria, one of the major complaints that they have is that the market is not deep enough. There's not enough liquidity in the market. All right. But now that we have a lot of these major companies raising more shares, hopefully that argument about the market not being deep enough or there's not enough shares to buy will not be there anymore. So that is the way I will seek to answer that question, Dr. Olugbemi.
Thank you, sir, for helping us unpack that.
Thank you very much, my president.
Let me add a word or two. Let me add a word or two before
thank you, my life brother.
So thank you very much, Bayo, for this question. But you see, as long as there is this momentum for buying shares, I don't see any negative impact either in terms of raising the required capital for the capital market operators or for their market to be affected. There's a lot of money going in there, and I believe when we start getting these earnings from all these quoted companies, that will encourage a lot of people to sustain this momentum. So I don't foresee any negative impact with that. And for the capital market operators, while I will say that we'll still have some time up to next year, but I think majority will definitely going to meet up with this. But there's nothing bad for people to start thinking of mergers and acquisition so that we can have a bigger, better firms that can be able to compete not only in Nigeria, but even outside Nigeria. So me, I'm very hopeful that there's not going to be any negative impact, even with the election that is coming up, even with the primary that some of the panelists have mentioned today. Me, I'm still positive that will sustain this momentum in our market, and we are going to raise all these capitals. Thank you.
Thank you, good chair.
Thank you. I appreciate it. Thank you.
Thank you for that, sir.
Well done. Go ahead, please. Thank you.
Thank you, sir. That was, you know, I love the optimism from Dr. Kwaranga. It was a very infectious one, and definitely we're hopeful that everybody going out there, every, you know, company, capital market operator, the banks, everybody will raise the capital needed. And the investors will be happy too, you know, at the end of the day.
And the momentum of the market will continue to go up.
Exactly.
That's
up
still
and
money.
up.
Well done, laddie. Thank you.
Thank you so much, sir. All right, do we have any other questions? You can signify by raising your hand, or you can also send us a message in the chat box. Okay, I see one in the chat box. This is from Mr. Festus. Because is asking, how sensitive is the NGX to FX volatility under the new FX regime, especially for foreign portfolio investors? I don't know, Dr. Kwaraga, is like you help us with this one. This is from Mr. Festus. It says, how sensitive is the NGX to FX volatility under the new FX regime, especially for foreign portfolio investors? I guess it's safe to say the FX market has been quite stable from 2025 and we're coming into 2026. Mr. Malegbe, I don't know if you want to chime in.
Okay, let me make an effort to answer that question.
Okay.
Okay, my
Dr.
chairman.
Yes.
Let me
Sorry, there's some phone calls that are coming. Well, I'm just trying to get the question. How sensitive is the NGS to FX volatility under the FX regime? Well, for me, FX has been very stable within the 1314 range, and in fact, it's even coming down. While I agree that may likely dampen some foreign likely investors, but I've not seen that in the market as of today. So while I agree, like the way he said, there's a possibility if the naira continue to appreciate against the dollar, that may likely discourage or dampen some of the foreign investors that are looking at our market. But I don't see that so much impact as at today and even going forward. But it's good for for our own local retail domestic investors for them to at least take that into consideration. That at least the naira is firming up. So I don't know whether today we can be able to comment on that, but I think the naira is a bit stable, the FX for now.
Yes. Thank you, Chairman, for that response. I mean, and I honestly flow with your thought process, because for me, I think the foreign investors, what they are looking for is stability.
Correct.
They do not want to exchange their money at 800 naira today, and then you tell them tomorrow the thing is now 1,200. They do not want that.
Correct.
So, you know, this stability actually works positive for them. At least they have some level of certainty that they can come in at a particular exchange rate and expect that, you know, when they are going out, even if there's fluctuation, it's not going to be that kind of wide frustration we used to have. So, and I mean, you can see that they are responding. In fact, I make both to say that the reason why we are seeing more of them inflowing their money now is that I suspect that a lot of them probably feels that Naira will still strengthen.
Correct.
And they would like to come in now at this exchange rate than having to come in at a lower exchange rate. You can see that the exchange rate has broken that 1,400 Naira psychological barrier already. All right. So we are now at 1,395, 1,390 or so. So the ones that want to come in will rather not come in now, rather than wake up to next month or 2 months and see that they have to be looking to exchange their dollars at 1,200. So most of them will most likely continue to come in now, particularly since they see that the Naira is strengthening. That's my take.
Yeah, thank you for that, Saz. And I guess definitely from a local investor perspective, definitely you'd love to see your currency strengthen. And I guess from a foreign investor perspective, I guess they'll take stability over strengthening at this point. Thank you so much for helping us answer that question. I'm sure we have a couple more questions here. Okay, looking into the chat box, we have one from Oluwafemi Bankole. He's asking, looking ahead, what are the biggest downside risks to the 2026 outlook, and how can policymakers build resilience against them? Definitely, there's always risk at this point, no matter how you look at this. But even though there's risk, we have to have those hedges. And he's asking how policymakers can actually help out here.
We have one of the policymakers here in the person of the chairman, group chairman of group chairman of the NGX is there.
You are taking your policy makers, and you can.
Yeah, so you are one of the policy.
I thought that you are going to go to Nami first. Let's hear from Nami.
Okay.
Even though he's retired but not tired.
Professor,
He's not tired.
Very true. With us, sir?
Very true.
Alhaji Nami, are you with us? Oh my God.
Not too much
Alhaji Nami is here.
Not too much of a trader, but I was careful, like I said, while I was making my presentation, and I'm happy that cautious approach has helped. And because I did not talk much, nobody is able to ask me a question. So that is the first thing I would say. But the lead presenter, Dr. Owaleke, gave us something on DHL. I don't know whether the person who asked the question was not around that time. He was talking about diversification before the concept of aging, and he specifically insisted that as a local investor, we should choose to invest wisely do it on a long-time basis. We shouldn't be thinking of 1 month, 2 months, or medium time. If we really want to make progress because of the way our manner issues are straightening up, we should choose to do long-term investment as against short or medium-term investment. This is just the little I can say about that, except if there are more on taxation.
Thank you so much for that, Haji Nami. Definitely helped us there. I don't know if okay.
Hello, Ladi.
All right. So hello. Yeah, Dr. Kwaranga.
Just a word or two. I heard what Nami had said. I believe, based on the question, first of all, I think it's the election. And the way our president is going, I don't foresee so much challenges in terms of the election. So that risk, like the way you said, risk must always be there. But the major risk for this year is this issue of that election. And the way that we are going, I don't see so much competition. Our macroeconomic indices have all stabilized. Yes, there is this issue of the US related that we can take that into consideration too, which is another risk that may likely affect the policymakers. But be as it may, I think the major one is the election, and I don't see so much issues from that one too. Thank you.
Thank you so much, Dr. Kwaranga, for that.
Ladi, if I just add to that quickly.
Please, sir.
And I think that, honestly, Dr. Nami has nailed it on the head. The only way to hedge against volatility is to take a long-term position. All right? Because circumstances will always change. In as much as, positions one has taken regarding investments are driven by fundamentals, and that your horizon is long enough, all right, irrespective of whatever short-term volatility that happens, you will see that you are more often than not able to weather those volatilities, and your investment portfolio is able to withstand them. So it is important that investors bear in mind that irrespective of whatever the state of the market is at any particular point in time, you just have to ensure that you stick with fundamentals and ensure that your investment horizon is reasonably long enough, such that whatever short-term volatility happens in the market, you are not forced to have to take a loss. So that's what I would like to add to that.
Thank you so much, Mr. Molegbe, for helping us add some 2 cents there. And definitely looking at all that's been said, so far, I believe we have a good direction when it comes to what to expect for Nigeria's economy, the capital markets, and how investor sentiment is going to shape what will play out in 2026. Definitely, we've been taking all the questions that we can, and at some point we'll be anchoring. But in the absence of any question now, I'd like to just chip in one to Dr. Nami. Definitely, a very insightful presentation you gave earlier, telling us when it comes to the thresholds, where the capital gains tax really apply. I'd also like to get your perspective, looking at it from the foreign investor side and the local investor side of things. How optimistic are you about the new tax laws and the impact for Nigeria's capital markets?
Okay, thank you very much. I was praying that nobody asked me this question, but hence you have, I'll be able to also cautiously answer the question. From my presentation, I made it clear that one of the core principles that guided the tax reform was harmonization of taxes in the first place, to reduce number of taxes in Nigeria to a single digit. So let us first of all have that at the back of our mind. And as a result, capital gains tax itself was removed as a separate item. But taxation of gains still subsist, because the gains will be included and taxed as income under company income tax or personal income tax for the individual. This means that the rate applicable in taxing income or profit will also apply to gains. In this way, the rate of 0 to 25% will apply in respect of individual, depending on the tax rate bands that apply to the taxpayer. There are tax based bands. If you earn between this and this, you pay this percentage, and the maximum rate is 25%. And for companies, it will either be 0% or 30%. But the statement I withheld is that this 30% is not a nominal rate. In other words, it does not mean that if you earn 30 million, for instance, the change of the rule automatically makes us that the 30% will apply on a straight line basis on your 30 million. This is because the new rule allows that the gains is included in accessible profits. This means also that any capital loss will be used to reduce business profits. And business loss may be used also to offset capital gains. So the fact that you earn 30 million naira gain does not mean that you are going to apply 30% as against what people are telling, the misinformation that is there. So just the way you calculate company income tax by taking certain relief and by deducting certain allowable deduction, you are also going to do it here before you apply 30%. And if as a result, it may sometimes result also into low or no accessible profit, which may reduce tax payable. So it also means that businesses with low business profit but huge capital allowance claim may also offset the capital allowance from the capital gains. That is what we are saying. So the misinformation in the public, while we are keeping quiet, we are no more in government so that people will not insult us that people were trying to get government to patronize us. But the bottom line is these things were packaged by FIRS, reviewed by consultants that were appointed to as presidential committee headed by Mr. Taiwo. So they were careful. They had investors. They had their clients in mind. So they did not just roll out the word 30%, though it's a progressive tax in a manner that it will hurt businesses. While the new rule may be significant for the individual, it may not be so for businesses. Data generated by some of the reviews we carried out in 2024 and 2025 suggests that less than 400 taxpayers pay capital gains tax above 1 million in the whole of the year 2025. And only 200 paid capital gains tax above 1 million in the whole of the year 2024. So the effect of change of rule will impact only few taxpayers. And I think Taiwo Edele has done well by education foreign direct investors, and they've understood. So the above data analysis also show that the issue is also not significant for capital market, has been exaggerated. So this is the little contribution I will make, and I don't know whether that makes sense for you.
Thank you, sir. I guess, from what you said, I guess you are optimistic that it will favor investors. Thank you so much. Thank you, sir. And definitely I've had the best time today, and I've learned so much from this series. And I say a big thank you to ASAM for allowing me to moderate this. Thank you so much, Dr. Nami. Thank you for helping us unpack the tax angle of this conversation. All right, at this moment now, time is fast spent. I'll hand things over to Mr. Olatunde Amolegbe to help us, reel out the vote of thanks and what to expect. Thank you so much.
Well done, Ladi. Well done, Ladi.
Thank you so much, Ladi, for the excellent job always. I think this is the fourth time you are moderating this for us, and we always enjoy your professional handling. Thank you. Thank you so much. Let me use this opportunity to thank every single one of us that have dedicated this afternoon to spend with us. Our hope is that we've been able to add value to your afternoon. Hopefully, we have been able to add value to what you plan to do regarding investment for 2026. Hopefully, we have also been able to allay some of the fears you might have regarding these issues of tax or no tax and not tax, by the panelists we've brought and the insight they have brought to the issue. I would like to especially thank a few people. All of us obviously are important for us to have taken the time to do this, but obviously I would be remiss if I don't especially thank some people. Obviously, I would like to thank our guest speaker, Professor Uche Nwaleke. He's always come true for us every time we call him. And we can see the quality of the presentation has made. I mean, that is a presentation worthy of a professor. All right, and then we will clearly share it with every single one of us so that we can have it in our library to continue to look over it. You know, and I can assure you that if you follow his recommendation, there's absolutely no way you will not do well in the markets for 2026. So thank you so much, Professor Owaleke, for your presence and for always being there for us. To Dr. Mohammed Nami, we called you and you realized that this is a very, very important issue, that you needed to add your voice as someone that had been on that seat for our nation. And you responded to our call, and your contribution, I'm sure that our participants really, really appreciate. Thank you for coming on. Thank you for listening to us. And we thank you for your contribution. And my hope is that whenever we have cause to call on you again to add your voice to such important national issue, you will be willing to oblige us. Thank you again for answering our call. To my ebullient group chairman NGX, my live brother Alhaji Dr. Umaru Kwaranga, the Serikim Fulani of Gombe. Thank you for always being there. You really, really surprised me by your presence. And of course, you know, your presence always liven up every event or everywhere you are. You are highly appreciated, sir. You are highly appreciated for your contribution, for your wisdom, and for making every investor in this our market richer. Thank you so much.
Thank you very much. I appreciate it. I appreciate it. Thank you. Always well. Yeah, always
yes, thank you, sir. There are a few other people I would like to recommend. I recognize the chairman of Auto Steven Asset Management is here with us, Alhaji Ahmed Jinge. Thank you, chairman, for joining us. Some of my directors, Alhaji Isa Umar, Mr. Jide Olorunfemi, Alhaji Adamu Mele, they are all here to support us. A director in SEC and one of the top stockbrokers in the country, Alhaji Umar, Alhaji Kasim Kurufi is here. Thank you for spending time with us. Dr. Bayo Lugbemi, former president CIBN, thank you for your participation and for spending this afternoon with us. The first vice president of CIS, Mrs. Fiona Aime, thank you for spending the time with us, and for everybody for taking this time to spend this afternoon with us. We hope we had value to your afternoon. We hope that you will continue to participate in the market, and until we see you maybe sometime in July to review what we have said today, and then see whether we're on course or whether we're off the cuff. We hope to see you then in July. Again, once again, thank you for coming, and see you in July. Thank you.
Thank you.
Thank you, and bye to all. Thank you. Bye-bye.
Thank you. Bye-bye.
Bye-bye.
Yeah.
Thank you.
Thank you, sir.
Well done.
Thank you. Thank you. Thank you for me.
Thank you, sir. Bye-bye. Thank you. Thank you.
Bye-bye.
Thank you, sir.
Thank you.
Yes, sir.
Thank you, sir.
Thank you. No bad.
Bye, Mr. Mali. Okay, possible.